Or you have Colombia, which has plus 200 points above. So the reason why they have this information here is when you have coffee traders in Colombia basing their trades on the futures market, they decide how they're going to sell their coffee by adding their premium of 200 points or subtracting their difference of, in this instance we have Venezuela and Peru, which has a minus 100 points, subtracting their difference from what the actual price is, and that lets them know what their market value of their product is. It's a very great system. It allows people in almost impossible areas such as Burundi, India. We even have Rwanda on here, Dominican Republic, Ecuador. It gives them an idea of what the fair value, market value of their product is in the world market, and allows them to not have to barter and overthink how much their coffee is worth. So it's a very unique system, and this is very important as we discuss later what basis means and how we can profit from these discrepancies between the actual value of the futures contract and the actual value of the cash market. And then to again show that futures are actual items, we show that they have delivery points. And in this contract we have delivery points in New York, New Orleans, Port of Hamburg, Port of Antwerp, Port of Miami. So when you speculate on a futures contract, you're actually obligated to each and every single one of these points in this contract. So it's very important as a future speculator not to be caught having to deliver or take delivery of one of these items. This is an example of a single stock futures contract. Single stock futures just last week, I believe it was February 6th, 2004, reached 2 million contracts since November 2003. And they're going to become more and more an integral part of the speculating world. These contracts are a lot more simpler than the typical futures contract, but they also have specifications. In this contract, it represents 100 shares of any underlying security, Microsoft and Amgen being the top single stock futures being traded right now. There's a minimum price fluctuation of $1 in this instance, and they also have regular trading hours, 8:30 a.m. to 3 p.m. And then they also fall into position limits. As we said before, large speculators and hedgers have to report their positions. And in this particular contract, either 13,500 net contracts or 22,500 net contracts is the position limit. And only major hedge funds and major mutual funds would actually be at those levels, but it's important to have these position limits so that the CFTC knows who's participating. In these contracts, there's no daily price limit, and the reportable position level is 200 contracts. 200 contracts is something that major or large speculators, as we mentioned before, would trade, and so they're required to report this. And this is very unique to futures trading, and we'll discuss this more about the various CFTC reports. But since they have to report, that gives us an indicator of exactly where the market is heading, where it plans to go, and it leaves a lot of footprints in the sand for us to kind of guide us in our own trading. We also go into the contract months, and it talks about March, September, and December being main months and how it follows a quarterly cycle. And again, it falls back to understanding when these contracts expire. And then we look at the expiration date, which is the third Friday of the contract month. And we then look at the settlement and delivery. The great thing about futures, these new single stock futures contracts, is you actually can receive delivery. And sometimes it's a good thing for those people who've had an opportunity to buy a stock low and then want to continue to add it to their overall portfolio. And so there's actual physical delivery of single stock futures. They're a great investment vehicle for people to kind of test out ideas and theories and commit to them once they decide that they like the investment. Now, contract facts. There are approximately 11 exchanges in the United States. Of those exchanges, 4 to 5 of them do majority of the business. The other ones are local exchanges that help create liquidity, but really are domestic to where they are. Of all those exchanges, only 370 have active futures contracts. Now, 370 may sound like a lot. When you look at the universe of stocks, which can exceed 10,000 various different stocks available to you, 370 active futures contracts is not very many. And most likely, of those 370 active contracts, only 30 to maybe 37 of them, about 10% of them, really have a lot of volume and a lot of liquidity for you to trade. So it's a small universe when it comes to trading futures and traditional commodities. Each commodity that you do trade has its own special margin requirements, as well as frequency and values of the movements that they make. And we'll discuss that in a moment. And futures contracts operate on their own independent time cycles. So don't fall into the sense that because you know what's happening in soybeans or because you know what's happening in the euro-dollar market, you can translate that immediately over to the treasury bond market or coffee. Understand each and every contract that you decide to trade, the times that it trades, the expiration dates, and the margin values, because every single futures contract is unique, even though it's standardized for its industry. Here we have an example of a margin sheet. And I try to take a broad sample of some of the more actively traded futures contracts. So we started off with the S&P 500. We have live cattle, coffee, gold, crude oil. I even threw in the Eurex bond, treasury bills, and soybeans. And what's important is the headings. We see that they each have a unique contract size. We see that they each have a unique point value. And then we have initial margin and maintenance margin for each one of these contracts. So for instance, with a full-size S&P 500 contract, the contract size is 250 times whatever the value of the S&P 500 is. So if the S&P 500 is at 1,000, we're looking at 250,000 quote-unquote dollars represented there. The point value is $2.50 per point, and then the initial margin is $17,813. It's important to understand the difference between initial margin and maintenance margin. Initial margin is what you have to put up in order to the first earnest deposits you have to put up in order to first enter the trade. Now, if the trade starts to move against you and it goes below $17,813, that's okay, as long as it doesn't exceed the maintenance margin of $14,250. If it goes below that, then you have to put up more money and to reach again the initial margin. And this is what is known as margin call in futures. If you find yourself having to come up with margin call, you've committed one or two of the mistakes we talked about in the last seminar. Either you're over trading your account or you don't have enough equity in your account to trade this type of contract, and you may have to change your style of trading. One of the great things is now that the S&P has a mini contract. I believe Pristine offers the S&P mini contract. It's very popular. In fact, it took, when the E-mini S&P came into effect, it took something like 30% to 40% of the business away from the major contract because people didn't want to commit so much capital. Another contract we can look at is live cattle. 40,000 pounds of cattle. Each point value is worth $4, and the initial margin is $810. There's nowhere else you can go in the investment arena and control, anywhere from $160,000 to $200,000 worth of cattle for only $810. And that's why I said before that you have to be very careful with how you invest, because the leverage can be very high, 10, 15, 20 times the actual value of the contract. We look at gold, which is very popular in the news, margin $2,025, crude oil $3,375. These are all reasonable amounts, but don't fixate on the margin as your sole investment. You always have to have more in your account than what the required margin is in order for you to successfully trade these types of contracts.